So when you're driving across Kansas and you come to a little town, it's about time to eat lunch. How do you figure out where to go eat lunch? Well, you don't Yelp it. You don't look it up on any of those apps. What you do is you pull into town and you start looking at lunchtime to see where all the farm trucks are. Because where all the farmers are parked for lunch, and there'll probably be some police cars there too, that's a pretty good sign that that's a good place to have lunch, because what you're seeing demonstrated is demand. Demand. That's the restaurant that is in demand, and it's in demand because they have a good product. Now, what does that have to do with investing? Ralph, one of the wonderful things that we're able to do that we couldn't do 30 years ago when I first started in this business, 31, 32 years ago now, is today we can measure the demand of any investment and compare it to the demand of another investment. We can compare the demand of the market overall and determine whether or not the market is in demand or the market is in supply. And we only want to be invested when the market is in demand. For example, all of 2022, you remember that's the year the market lost about 20%. We were totally out of the market then because the market was in supply. It wasn't in demand. And if you'll think about what demand does, when there's a lot of demand for something, it lifts the prices. And so we want to only invest in times when it's in demand. And in times when the market is in supply, we want to step aside for a time period. And by stepping aside when the market's in supply and prices are falling, we don't have to participate in that. So that's how we buffer ourselves against a volatile stock market. And I just call it picking a place to go to lunch in a Kansas farm town.